Hey traders and investors, it's Serge Berger here. Today we're going to look at shares of JP Morgan, which along with the rest of the banking stocks for that matter are rallying again today. And that's really on the back of the Fed playing somewhat of a tricky game. Now, before we look at the near term, keep in mind what the chart looks like in JP Morgan all the way stretching all the way back to 2007. You can see we finally broke out past resistance like the broader indices did as well. In 2013, we then pushed higher. We've retested this support area last August, at least on an intraday basis. And so far, we continue sort of this consolidation phase that we've been in. Right now, if we zoom in a little bit closer, and I think this is where it gets really interesting, is we have to understand that the Fed is kind of in a pickle, right? I mean, for one, economic growth isn't really there to support a rate hike. In fact, we've seen decelerating economic growth in rate of change terms, but we are seeing basically inflation expectations pick up. So what the Fed has been doing here over the past, in this case, the past few days, maybe the past couple, let's say the past couple of weeks or so, is something that I think is very similar to what it did back here last October into the early part of November, and that's basically becoming somewhat hawkish, so they can then become a little more dovish again. In other words, what they're basically doing is sort of giving themselves room to be wrong, and actually then for Janet Yellen to come out and sort of backpedal what all the Fed speakers have been doing over the past couple weeks, and thereby sort of almost kind of giving the world a rate cut. It's sort of a silly and almost kind of a sick game, if you will, for the lack of a better term. But basically, JP Morgan, purely technically, and that's what I'm trying to get to, does look like it wants to fill a gap. So basically, what we're looking at here, and you can kind of forget these moving averages. Let's just get rid of the moving average because they're kind of silly for this stock. So we'll go plain white chart, and you can see what JP Morgan here is as of the time I'm recording this. Is the stock is breaking past horizontal resistance where it's been struggling for quite some time, and although this hasn't been the most severe breakout where it's just in the going, and maybe what the next upside target here could be is that down gap from the 4th of January, so basically the first trading day of the year. So maybe the banks want to, or at least JP Morgan in this case, wants to fill that gap. Now that's not a huge trade to the upside, but for those of you guys that want to play JP Morgan or the banking stocks for a little bit of a further pop, it's an interesting one as a first price target higher, because ultimately, if Janet Yellen comes out and starts speaking dovish again, in other words, takes the foot off the pedal and starts, hinting towards less rate hikes or more data dependency, whatever she wants to do, then the bank is actually going to have a very difficult time to rally. So I think this is an important thing to keep in mind here, that the Fed is very much behind what's driving these banking stocks in the near term, and for that matter, what's driving the broader stock market in the near term. And that's, again, somewhat silly and sick, but it's nothing new. We've seen this now for the past 6 years. It's just that ultimately, even though the Fed might be able to control the near-term movements, economic gravity and economic reality, for that matter, they will not be able to basically distort for the intermediate term. So that's what's going on here, guys. Please follow me on Instagram if you want to see more behind the scenes of what it's like to be a trader and active investor from a lifestyle perspective, and tips and tricks and office views and that whole kind of thing. Also, like the video, please share it with as many people as you can, and I will see you in the next video.